मास्क उधर का नहीं है नहीं Dear all, may I request all to please be seated. Dear all, I request everyone to join us here as our DG sir has arrived. May I request everyone to please take your seat? Chief Executive, IBA, and Madam Jyoti Vij, Additional Director General, FICCI. Dear ladies and gentlemen, I would now like to invite Shri A.K. Goel, Chairman IBA and MD and CEO Punjab National Bank for welcome address.
Thank you very much, Pooja. Good evening to everybody. Friends, as you all are aware, FIBAC 2023 was started yesterday, and the theme of the FIBAC was winning in the uncertainty. And a lot of deliberation, and the panelists was attended this program, and we have got the feedback from all the eminent speakers also, how to live in the uncertainty, and it should be treated as a opportunity rather than ki we are thinking on the negative side. And lot of panelists was there, and they were a discussion on the corporate finance, they were discussion on the SME financing, there was discussion on the risk management, there was discussion on the climate financing. So the thought of all the panelists was very nicely deliberated by them also, and definitely it has given a lot of input to all the audience also. So friends, we have reached today to the validation session also, and it is my really pleasure welcoming Sri Rajeshwar Rai ji, Deputy Governor of the Reserve Bank of India. Sir, we are fortunate to have your presence, and I am thankful on behalf of the FICCI as well as my personal behalf and also the behalf of the IBA, sir. You have accepted our invitation and graced the occasion. You all are aware, Rao Saab doesn't need any introduction. Everybody knows about the Rao Saab. And one more thing, even, however, I will glad to inform you, the Rajeshwar Rai ji is very seasoned central banker, and he was instrumental in the Reserve Bank of India for regulation, credit monitoring, and the communication and law enforcement also. So I will not take much of time because everybody is eager to hear the Rajeshwar Rai Sahab, sir. With once again, sir, before I conclude, sir, I place on the record our sincere thanks to you for your grace presence also. Now, sir, over to you. Thank you very much.
Thank you, Goelji, for that kind introduction. Distinguished guests at this conference, a very good evening to all of you. At the outset, let me thank the Indian Banks Association and FICCI for inviting me over to deliver this address today. It's indeed a pleasure to be here amidst such a gathering of important stakeholders across the spectrum of our financial landscape. In a very short span of time, FIBAC has achieved a prominent status of being a premier brainstorming event on emerging themes of relevance to the financial world. I'm sure all of you have had a very open and insightful set of discussions on several important issues over the last 2 days. The theme of FIBAC 2023, winning in uncertain times, is very apt in the current scenario. Therefore, my remarks today would center around this theme, that is managing the uncertainties that we are living with and those which lurk in the horizon, and later dwell upon how we could navigate such uncertain times. When we think of uncertainty, we immediately think of risk and risk taking and risk management. The people in the field of finance often have a love hate relationship with risk. While most entities are willing to assume risks on their balance sheets, sometimes there are reservations to plan and provide for it, often due to the costs involved. While there are obvious incentives for taking risks, an overdose of risk in a leveraged entity is like a bank or a finance company can be disastrous if it's not managed efficiently. Therefore, the regulators and policymakers endeavor to make the policies to facilitate overall financial stability and occasionally give out didactic fiats and guidance stressing on the importance of systemic resilience. Beg your pardon. To give you an analogy, the prudential guidelines are akin to a diet plan given by a physician. If you stick to it, your balance sheets would look healthy. Then, as supervisor, RBI also conducts an annual health checkup in the form of on-site visits to see what looks apparently healthy from outside reflects the correct position with no hidden illnesses. If indeed there are symptoms of illnesses, medication in terms of a time-bound action plan to not only treat the symptoms but also address the root cause is prescribed. In a way, prevention is better than cure is an apt mantra for the financial world as well. Drawing a reference to the 5 natural elements which human body is composed of, let me outline my version of 5 elements that make the foundation of a robust and resilient financial system. These are strong governance and management, sound regulatory principles, adequate capital and liquidity, strong supervisory and risk management practices, and finally, effective crisis management and resolution frameworks. I do not think that I need to elaborate much on these elements as these are quite familiar to this distinguished audience here. Our microprudential risk management framework revolves around 2 very simple yet powerful measures: provisioning and capital requirement. One for the anticipated loss component of the asset portfolio at risk, and another for the unexpected loss component. The third component, that is the liquidity, has been under a lot of discussions in the global forums of late. However, it may yet be worth reiterating that in India, we implemented the statutory liquidity ratio way back in 1949, which required the banks to maintain a level of high quality liquid assets, mostly in the form of government securities, to essentially address this concern. The importance of these measures have been reinforced repeatedly through frequent international episodes of financial crisis. Perhaps the higher quantum and better quality regulatory capital requirements have helped the financial system around the globe to navigate through the turbulence in the wake of COVID and other crises that we have experienced of late. A resilient financial system is one that can withstand and quickly recover from the episodes of such financial shocks and crises. Such a financial system also requires early identification of vulnerabilities and risk buildup in each of these entities, both at the entity level as well as the system level, and initiation of appropriate corrective action. So it's of utmost importance that the banks as well as other financial entities are always vigilant regarding the buildup of risk pockets in their balance sheets and operations, adopt prudent risk management practices, and are transparent in disclosing the risk to the regulators and other stakeholders. But given these risks and the changing paradigms, let me, I think it's missed out a bit, sorry. The recent crisis episodes in the US and Europe have brought back the question of robust and sustainable business models again to the fore. The business models of the banks have evolved depending on the roles they have played throughout history, with the current focus being on the intermediation paradigm, that is, acceptance of deposits and credit creation. However, this approach needs to change with newer players entering the financial service space and disrupting the traditional rules of the game. In the newer paradigm, markets are likely to become the central point of intermediation where the banks may become but one amongst the host of other entities interacting in the marketplace. The traditional business model needs to pivot to address this evolving paradigm. Another important transition which is underway is the changing consumer preferences. While this customer driven evolution is often slow, it is mostly defensive and non reversionary. It is mostly definitive and non reversionary. The future of banking cannot be imagined without visualizing the needs of the post generation Z consumers, those that are yet to be tagged by an alphabet. The future generation of customers are likely to consume financial services in the same way that they consume other products and services, and banks may have to be prepared to make that transition. Therefore, let me imagine the contours around a few aspects of where we would be likely to see banking in the next decade or so under the marketplace based and the consumer preference driven paradigm. Let me emphasize here that what I am going to tell you lies in the future, more in the realm of probable, but the undercurrents of this transition are already visible. The first point is that the banks will have to transition from a sectoral approach to an ecosystem approach. The oft repeated pitch that all banks of future will actually be technology companies also undertaking the business of banking. While it's difficult to ascertain that this will indeed be the case, it is likely that the era of exclusiveness of providing banking services by banks are over. With the banking as a service model making steady and silent inroads, the banks have to operate as part of a larger ecosystem with good number and varieties of non-bank players in the mix. A lot of these transformations are already becoming visible. Banks and NBFCs are partnering with fintechs to deliver financial products and services by deploying innovative methods and technological solutions. Second, the banking of future is going to be hyper-personalized, and banks may have to shift from isolated service provisions to hyper-personalized embedded banking. In future, probably banking may cease to be a separate service. Instead, banking would be embedded in all the products and services which the consumers are expected to avail. Embedded finance is the integration of financial services or tools within products or services of a non-financial organization. So, in future, customer may not have to visit a bank branch to avail a home loan. For example, when you log into the Builders app to book a flat, the app could be integrated into the bank's app or to a fintech's platform, and when you enter your KYC identifier, the loan eligibility would be automatically calculated using your consent to pull your financial and non-financial information through an account aggregator or a DigiLocker, and the loan would get disbursed. All this would take place within a few minutes, if not seconds. Technological solutions would allow banks to offer prices that would continuously adjust to customer behavior and preferences while responding to supply and demand position, margin requirements, and competition. All this hyper-personalization would become possible as we increase our digital footprints and the banks or their partnering digital companies learn how to get artificial intelligence or machine learning based decision outputs from this data. Third, the current form of business segmentation may give way to customer preferences based verticals. The focus of tomorrow's bank has to go beyond just its business to better meet the customer's needs. Hence, the segmentation will be based on homogeneous customer groups, and all products would be designed to serve these segments. Hence, the core strength of the successful bank would be the customer segment specific. Even now, some banks, often in partnerships with fintechs, are trying to target some specific segments such as the MSMEs, women, senior citizens, and millennials. We already have examples elsewhere where the traditional banks have failed to innovate and adapt to the new needs of the customers. Disruptors such as the new bank in Brazil have come in and captured the market, filling the vacuum and offering products and services that were demanded by the customers. Finally, the traditional breakup of assets and liabilities may likely undergo drastic changes. Currently, the balance sheet of Indian banks are dominated by loans and assets on the asset side and deposits on the liabilities. We could expect transformation of the composition of the bank balance sheets during the forthcoming decade, driven by the natural progression of the Indian economy. This transformation will be further propelled by the widespread integration of technology into business operations and decision making. It is possible that the customer preferences in future may shift from passive saving products like a fixed deposit to more esoteric and market-linked investment products. Alternate avenues will compete to tap the depositor's money on account of better returns and convenience of a finance super app to meet all the financial needs that may become the norm. Tokenization of assets and liabilities using the power of distributed ledger technology may change the bank balance sheet in structures. All these changes would mean adjustments to the traditional asset liability structure of the banks. So given these risks and changing paradigms, let me share a few thoughts so as to how we will have to manage these challenges. As the bank balance sheet transforms, we, and when I say we, I mean both the Reserve Bank as well as the banks, would have to refocus our priorities from a risk management perspective. From the regulatory side, we may have to relook at the risk management frameworks, especially for liquidity and market risk. From the bank side, active monitoring of deposit concentration and diversification of funding sources may become even more important. As the March 23 banking crisis in the United States and events at Credit Suisse showed, despite having capital and liquidity comparable or in some cases better than the industry level or the peer levels, the banks failed. Therefore, to address these concerns, we may have to look at qualitative matrices such as enhanced disclosures, strong code of conduct, and clear governance structures. Simultaneously, the self-regulation by the industry through self-regulatory organizations needs strengthening to promote responsible conduct and innovation. We have to focus on fortifying the cybersecurity and prevention of cyber frauds in a hyper-personalized and high-tech banking environment. The banking landscape is fast evolving with increase in financial inclusion, customer access, product choices, and convenience. However, the risks to the consumer have increased. There are increasing instances of frauds and data breaches. Customers today are facing a threat from technology-induced frauds such as fraudulent apps, breach of privacy, and deep fakes. Even mis-selling has emerged in a digital avatar called the dark patterns. Dark patterns are designs, interfaces, and tactics used to trick users into desired behavior such as availing of high-cost short-term consumer credit masquerading as an instant loan. We must work hard, work smart, and work together to protect the customers from these threats to retain and strengthen their trust. A key element of protecting customers is to provide them with an efficient, prompt, and cost-effective grievance redressal mechanism. Unfortunately, it appears that the efforts of the banks to provide timely solutions to customer grievances have not kept pace with the explosion in technology and products. While the banks are hugely invested in forging new and innovative ways of customer acquisition, very little thought seems to have gone on to improving customer grievance redressal mechanisms. To me, it seems very odd for a sector which prides itself on being a service industry. This seems very odd for a sector which prides itself on being a service industry. We definitely wish to see more serious thought and intent emerging from the boards and top executives on the quality of grievance redressal instead of just monitoring the turnaround times or the MIS on complaints. A related point which would help the banks in winning customer segmentation paradigm is bringing in greater empathy into their services, products, and operations. For example, there is a need for greater effort to provide safe and friendly tech banking to senior citizens. Banks must require their employees to treat senior citizens or people with special needs, those that are technologically challenged, or someone who may need help otherwise with special care and empathy. The boards must ensure that their access points, the branches, the websites, and apps are user-friendly and convenient for the customers with special needs. From the regulatory side, we are taking up these subjects more vigorously in our interaction with the industry. But there's also a need for a cultural and attitudinal change within the fraternity, which I would like to emphasize. To conclude, I would like to say that over course of time, it has been said several times that we need banking, but not banks. The prophecy has not yet come true. I'm certain that the banks will continue to be the primary drivers of the India's growth story. But the trajectory that the banks will adopt during this transition will determine how the banking landscape will look like in the next decade. As far as regulations are concerned, they have to keep in view the overall financial system stability, ensure resilience of the institutions, and attempt to bridge the information symmetry. While we laud the fact that the next gen banking is fast becoming a reality aided by innovations in the fintech space, we also need to continuously work to redefine the regulations and the regulatory frameworks to support these innovations and deliver on our mandate of financial stability while protecting the customers. At the same time, innovations and collaborations need to be well thought out, risks properly analyzed, and mitigation plans put in place before offering the products to the customers. Thank you once again for this opportunity to share my thoughts with you on this momentous occasion. Thank you.
Thank you very much, sir. I now welcome Madam Jyoti Vij, Additional Director General, FICCI, to deliver the vote of thanks for this session.
Thank you, Pooja. Before we begin, I would like to request Mr. Goel and Mr. Mehta to felicitate Mr. Rao with a green certificate. So this signifies the green economy concept of ours, and these are a few trees grown in your name at the Sundarbans. So that's a little contribution to the green economy. So we started our day yesterday with the Honorable Governor, who spoke about the need for the balanced regulations to have the resilient banking sector in order to support the growth aspirations of the economy. And hearing from you, someone who's been a career central banker, you've also kind of led down the entire the futuristic landscape of the banking, which is likely to emerge with all kinds of, target segments which need to be kept in mind while designing your products, but also to take care of their needs. Banking indeed is going to be something which is going to stay as long as the economy is there. How it is what is in their hands, and I think that's a very important message that you have imparted. I think something which is going to be very useful for the kind of audience that we have over here. So you did talk about the need for SROs, and yesterday Honorable Governor particularly talked about fintech. And banking fintech obviously is going to be a very important partnership that you just mentioned about. So I think that kind of an SRO is going to be an important conduit between the players and the regulator. And I think a lot of innovation that is developing today, and it's being supported a lot by the sandbox at the RBI. I think this kind of SRO will be able to really help control the way or maybe appropriately control the functioning of the both the fintechs and the banks in terms of innovation, in a way that the customers get benefited and the regulatory ecosystem also remains balanced and supports the customers going forward. So with these words, thank you once again, sir. And I would once again also like to thank Mr. Goel and Mr. Mehta for really leading us from the front in putting this event together, and to our knowledge partners, BCG as well, and to all the speakers who have been here and who will be joining us in the valedictory panel as well. Thank you once again.
Thank you, ma'am. Dear all, we will take 5 minutes to prepare the dais for the concluding panel discussion. Discussion for the day on emerging financial institutions landscape to serve Atmanirbhar India. For this session, I am honored to invite the panel of speakers to the dais. Shri A.K. Goel, Chairman IBA and MD and CEO Punjab National Bank. Shri Rajkiran Rai ji, MD NAFID. Shri Sunil Mehta, Chief Executive IBA. Shri Devadatta Chand, MD and CEO Bank of Baroda. And moderator for this session, Shri Ashish Garg, Managing Director and Senior Partner, BCG. May I request Shri Ashish Garg to initiate the panel discussion? Over to you, sir.
All right, sir, we are clearly in the last sprint for this FIBAC session. I think, first of all, my compliments. The deliberations that have happened have been just so wonderful, and we have covered a plethora of topics. We are kind of bringing this all together. You know, India is, we have already seen some policy intents being put out in public. We are speaking of a $30 trillion economy by 2047. We are talking of net zero by 2070. We are talking of, very bold, ambitious projects like India, Middle East, European Union corridors, which will have billions, hundreds of billions of investments. So look, at some way, it really looks fantastic. India is also going to be a very banking-led economy in some ways, which means if you compare to countries like UK, Japan, the banking assets to GDP will be about 150% from 70%. So there is actually a lot of, we may almost grow at 20-25% for the next 25 years to be able to catch up with this. We just heard Deputy Governor Sir about how things are changing, technology is coming in, customer segments are emerging. We will need to be part of these trends, yet we will be challenged to protect our market share and profit pools. I think in this context, let's frame our conversations around what banks can do to become Atmanirbhar, to support India's Atmanirbhar journey. Maybe I can start with one quick rapid fire to get some initial impressions from you. So to question to all the panelists is, please suggest from a banking perspective, what are the one or two things we can do as banks to really support India's ambitious journey to become Atmanirbhar? Yeah.
See, absolutely, Atmanirbhar is something which all players in the economy have been doing for last many years now. And the basic principle of Atmanirbhar is that we need to be self-reliant. And if you look at all the Make in India, all this, the starting that happened with Make in India, Vocal for Local, all this to make India Atmanirbhar. And the PLI scheme where the allocation was almost 2 lakh crore for the PLI incentive, wherein a lot of imported products are now being manufactured domestically, and banks are playing a big role there in terms of funding all this capex for that, is more and more making India self-reliant. And these numbers are also showing in different numbers that we see in the trade front. More importantly, what has happened in last many years now, that the inclusivity of the entire economic growth is something the banks have played a big role, whether it is a Jandan, whether it is a micro insurance, and the churn has been significant now. And almost now 40 odd crores people have been connected all through all these social scheme now. So that's something making India more and more self-reliant. And going to be, I think, the momentum has been at great pace to make India Atmanirbhar or Vikasit Bharat for that matter.
Thank you.
Most of the part has been covered by the Dev Chand also, because you have also told very limited and from the related to the banking sector.
Yes, sir.
Because we are in the service industry, I think customer service is also one of the point. We can definitely help to increase the Atmanirbhar Bharat. When we are talking about the customer service, I think what customer want? They want three things, in my view. First is they want convenience, they want right pricing, and they want the confidence. When we are talking about the convenience, they want whatever the product we are offering, it should be convenient to use. And second, when we are talking the right price, you can provide the convenience, but at the right price. And when we are talking about the confidence, confidence means whatever product we are providing through digital or etc., it is free from the cyber risk. So I think this can be the game changer also, and we are focusing also on this. Ki customers, how can we improve the customer service to make it Atmanirbhar? Thank you very much.
Thank you. For Atmanirbhar Bharat, we need Atmanirbhar banks.
Okay.
Okay. At present, actually, it looks so good that the banking industry is doing so well. We have passed through a lot of difficulties, but then now if you look at the profitability, and many other pyramid banks are doing very well. Again, drawing from what DG was speaking just now, can you rest with this comfort? Absolutely no. I think this is the time we need to really relook at the business model what banks are following. If you don't do that, because we are entering a very high growth phase. With the high growth comes the regulatory and compliance risks. You have seen this in NBFC space, you have seen in banking space, where the regulator comes down very heavily when there are breaches on the compliance and other issues, to the extent of stopping a particular product and all that. So I think when you are looking at very high growth phase, building a business model which is compliant and still deliver higher growth is very important. Whether the existing business model will deliver that, I feel no. Because what happened actually is we thought that the retail, MSME and other space will give us that growth. We went into technology space thinking that fintech tie-ups and all that will deliver us that growth rate and give us that growth. That was the thinking when we faced a problem with the larger advances. But then now we are exactly facing the issues there with the fintech related issues. Yesterday, governor spoke about it. Today, again, deputy governor is mentioning that. So a business model totally driven by technology, again, may not be perfectly suitable for banking. Maybe this model also has to be re-looked at. Now, country, when we are talking about Atmanirbhar Bharat, we are going slowly towards the manufacturing sector. Like service sector, we have done well. Agriculture sector anyway will remain there. But it is the manufacturing sector where the focus will be there. Now, traditionally, banks have lent to manufacturing by way of cash credit. Now, as a product, whether cash credit is relevant today, I think no. What will be relevant? It will be supply chain finance or many other products which is related to that. So, have we built that model? No. I think banks actually, like, the profitability, which has mostly come by way of reduction of credit cost, not by increasing operating income or reducing the operating cost. The operating efficiency has not improved. Operating income has not grown beyond a point. Right. It is only the credit cost which has come down, which has helped the bank to show higher profits today. So now if you are not able to encash on this sweet spot, what we are in now, and change the whole business model, relook at what we have done, and then prepare the banks to be really Atmanirbhar, so that the higher growth phase which is coming, we will be able to encash. The banks which are able to do it, in next 5 years, they will be the best. People who do not cope up with this, they will vanish.
Got it, sir.
In my view, Atmanirbhar Bharat means, in banking parlance, economically self-dependent. And the government has come out with a large number of schemes like creating of a institution like NEFID for promoting infrastructure, which will not only create employment opportunities, but will pull the demand for steel, cement, and various ancillary sector. Similarly, they have come out with a Make in India scheme, which provides a lot of manufacturing opportunities, and the target is 25% of the production. The manufacturing the GDP should come from the manufacturing sector. Right now, it's at 12%. So that provides a lot of employment opportunities into manufacturing sector. And because we are a thickly populated country, so employment opportunities are equally important to become economically independent. The Startup India, the Stand Up India, the various government schemes, they have been promoted by the government, but success of all these schemes are dependent on the banking system. Unless and until the banking system is geared up to support the manufacturing, the way it was said by Mr. Chand, that yes, we need to support this, and the way it was told by Mr. Goel also, that yes, customer service. Customer service, yes, of course. If we support these economic activities, you have got to have a good customer service. Ease of access. Easily the customer can approach you, they can get a fast delivery, they believe it, they develop a confidence into the banking system, and the system will improve. And rightly said by Rajkiran Rai ji, we just cannot follow the Western model. India still lives in villages. There has to be a combined effort on the part of a phygital model, where the assisted model in digital and a physical model in remote areas need to continue to support the Atmanirbhar Bharat. So banking system to support the Atmanirbhar Bharat had to be self-dependent, and that is what Mr. Rajeshwar said. And the self-dependent means they should have enough good systems to maintain their profitability, to maintain their sustainability, to support the economic growth that is desired by the country. And for that, I think the banking system is adopting ways, but still there is a way forward. Digitalization is providing some convenience in terms of customer service, but that is not the only answer, because digitalization brings up its own challenges of cyber security, of issues of the quick services into frauds and fraud-prone areas. So a holistic approach is to be adopted by the banking system to make it a Atmanirbhar Bharat, and I think our banking system is now gearing it up. Through these forums, we are deliberating on these issues to find out a most adoptable and apt solution for the Indian banking sector, which creates a blend of all these so that we can become self-dependent in times to come.
Excellent, sir. So, Rao Saab, the question is, thank you so much.
I heard. Just I will continue what all the other panelists have started. To make this, current era of Bank Nirbhar Bharat to Atmanirbhar Bharat, Atma will have 5 elements, everyone knows. In these 5 elements, one is government, second one is the regulator, third one is the end user, fourth one is the private entrepreneurs or the industrialists, fifth one is the lenders. You cannot make Atmanirbhar just making everything dependent on the banks. Unless until 4 other elements also starts functioning in harmony with the lenders, then only we can create the Atmanirbhar Bharat. This is the opening remarks. Thank you.
Lovely, sir. Thank you so much. I think we've really received such wonderful views. Let me just get into some small nuggets of what I have received from you. So maybe, Mr. Goel, I'll start with you. I think a lot of panelists have spoken about manufacturing. India actually has just 15% from manufacturing. Of course, industry is 29 if you add energy and mining and other things. Any developed nation will need to increase this. Panelists spoke about the PLI scheme. As PNB, which sectors you get very excited about? Where do you want to put the emphasis to really support Atmanirbhar Bharat from a manufacturing perspective?
Ashish ji, if you see from where the manufacturing is coming also, I think we should give the more focus on the MSME. Why I am telling MSME, if you see, the as on date, the contribution of the MSME in the export is around 45 to 50%, and they are contributing to GDP also around 30%. Even manufacturing also, their role is 50%. And if you see about the employment also, as on date, more than 6 crore units are working in the country, and they are creating the employment of more than 11 crore. So out of the total population, if 11 crore is being contributed employment by this sector, so I think and when I am talking this, I am not telling this only from the banker's credit point of view. I am telling from all the stakeholders, whether they are the customer of the MSME, whether they are the vendor of the MSME also, whether the government policies, whether the credit, everybody has to support. Because if you see as on date also, you all are aware, there is a significant gap in the credit is also available. They are taking the loan from the banking sector, they are taking the loan from the NBFCs also. You all are aware the loan from the NBFCs and unorganized sector also. As a banker, the role of the banker to support the MSME will be how we can bring this informal credit to the formal sector from the banker point of view. But in addition to that, whatever I am telling, because challenges of the MSME of different types, sometimes they have the competition with the large industries. There is a issue of the marketing of their product. There is a issue of the technology also. So there is a responsibility of, or even for the small MSME, if you see the number, the maximum number out of the 6 crore which I have told, the maximum number is the small MSME which we used to talk the micro. Even micro they are not having the accounting procedure, how to make the accounting of their whatever the sales, purchase, etc. Also, this is also one of the challenge. So if we will give focus for this, so every stakeholder support to the MSME, and definitely it will help to increase the manufacturing. In addition to that, whatever the government policy, the 2 lakh crore for the PLI, so there is a lot of scope in the defense sector, there is a lot of scope on the corridor financing also, and even for the climate financing for the MSME as well as the other corporate also. So, a lot of opportunities available to the bank for the support the manufacturing sector also.
I'm sure, sir, a lot of stakeholders will be absolutely delighted to hear this response. Sir, Mr. Rai, I'll ask you a slightly different angle about the future. If you think about India and the future of India, you know, a lot of India will get urbanized. Of course, agri remains important, rural remains important. If you look at cities today, New York is about a 2 trillion GDP city. Cities like Tokyo and Los Angeles are about a trillion. Shanghai is 500 billion. In India, even Mumbai is about 200 billion. Delhi is even lower. The governance of cities is pretty, we know, is average, with actually, except Mumbai, no other city earning revenues to meet its cost. As a startup, and I think, Mr. Goyal mentioned about that, Mr. Mehta, I think, mentioned about NAFED. How are you thinking about supporting this new India where a lot of thinking about not just money, but also policy, supporting variety of stakeholders will come in? So if you can just, I gave an urbanization example, but if you can lay out, how are you thinking about new areas?
Yeah, actually urbanization is the in thing. If you are looking at GDP of 10 trillion, we need to have at least 2 cities with 1 trillion each. Otherwise, we will not make 10 trillion. Comparative numbers, the Mumbai and Delhi are close to 200 billion now. They have to grow 5 times to reach that number. So there are only 2 cities which are in the top 50. It starts with New York, Tokyo with the 2 trillion, and then Mumbai and Delhi with close to 200 billion are within 50. Only 2 cities make there. So urbanization and these cities are very important. I will share one important statistics here. Both Bangalore, I'm comparing Bangalore because the IT city, Bangalore and Tokyo have the same area, roughly 2,000 square kilometers. The population of Tokyo is 3.6 crores. The population of Bangalore is 1.5 crores. Can you guess what is the number of private vehicles? Tokyo, for a population of 3.6 crores, they have only 30 lakh vehicles. Bangalore, for 1.5 crore population, they have 1.1 crore private vehicles. This speaks of the public infrastructure.
Right, sir.
Now, I am again connecting to my topic because ultimately if you want cities of this size, what we need is public infra. Now, the metro of Tokyo, the number of rides per day is 4 crores and it is only 6 lakhs in Bangalore. They have more than 4,000 kilometers of metro network and we have hardly 60, 70 kilometers. So now this is where the investment has to get in. Now there are 3 themes around which cities have grown. Now any big city you look at, they are either in financial sector like London, pure financial sector, pure tech play like Bangalore, or pure manufacturing like Chennai in India, that kind of thing. So cities grow and sometimes they are either one or maybe mix of 2. So we need to see, now Mumbai is more of financial services. Now Mumbai, you look at a place like BKC. Now BKC is a model where where the financial sector has really evolved and we see a lot of progress there. But then we are stopped there actually. Today even getting real estate there is so difficult. That can we multiply? Like within Mumbai, if you can have 3-4 BKCs, I think that is where you make it to 1 trillion.
Right, sir.
I think this investment in urban infra is important. Another important thing as we head towards 10 trillion is the quality of life. See, today we are about 40% population in the cities, 60% in the rural areas. Now it is going to go up by another 20-25% in the next 20-25 years. Now, do we have enough facilities here, whether it's healthcare, drinking water, sewage treatment? There is a huge investment which has to get into the cities. But we have some thought process, but then we need to structure these thoughts. It is governing issues and also financing models for financing this infra. Both have to emerge because we should have a right governance structure for these cities to really grow at that phase and also have the right financing model. Now, as NAPFID, we are trying to look at this space, but it is a big challenge because governance also, we have to fix a lot of issues before we really jump onto this expansion. But there is no way you can make it to 10 trillion without at least 1 or 2 cities making 1 trillion.
I'm really finding this fascinating, the visual of 4 or 5 BKCs in Mumbai itself. I think that's a very fascinating visual. I'm so impressed with this kind of an ideas. Let's move a bit of gears, and I'll come to you, Mr. Chand. Look, Prime Minister has given a clarion call of making India net zero by 2070. In fact, the idea is to achieve that goal much ahead. Bharat is dependent on oil, energy. We do not have energy security. 80% of energy still comes from fossil fuels. We are yet to really get deep into technologies where carbon capture can happen. Of course, green hydrogen, a few points have been made. Our land is getting increasingly degraded. Water is becoming scarce. We hear all of this and they are starting to affect us. They will start to affect the portfolio quality because if the businesses don't do well, then we have a problem on hand. It is also estimated that less than 25% of credit needs, green credit needs are being met today in the system. How is Bob thinking about the landscape of green finance and not just emissions, but even broader? What is your strategy? How are you planning to really support India and its journey on the green side?
Mr. Ashish, that's a very fair point because last time also in FIBAC, that is what a statement I made that the dependency on thermal or the normal resources would continue at least for short to medium term because that gives some kind of a stable source of energy and that is required for the economy to sustain. At the same time, what we are looking for last couple of years as far as Bank of Baroda is concerned that increasingly the incremental requirement, the incremental capex or investment happening on the renewable side. As on today, if you look at my green finance book, it is almost like in terms of USD, it is more than 3 billion now. And these are the assets acquired in last, let's say, a couple of 2.5, 3 years time. So the momentum is in the right direction, but then the incremental energy requirement would be met through renewables. At the same time, there would be a bit of substitution that is going to happen vis-a-vis thermal. So if I go by the government statement also, 2070 is the net zero, but then there would be a significant reduction in the thermal power by 2047. So we are completely aligned in terms of the requirement of the economy to fund more and more on the renewable side. Rather, some of the newer technology in terms of green hydrogen, Bank of Baroda has funded those projects also. So we do have capacity, we have created capacity within Bank of Baroda in terms of understanding this technology, pricing them properly, getting a right pricing for them so that the projects are viable and sustainable so that more and more investment goes into the sector. So clearly, Bank of Baroda is we do have a ESG policy now. I do have a climate risk sustainable cell in my bank now. Within Bank of Baroda, not only on the financing side, within also, we announced to the market that we unveiled a new logo called Bob Earth that clearly talks about the commitment of Bank of Baroda towards the climate. Internally also, like many of our branches are again run by rooftop solar. So there is a great commitment by Bank of Baroda on the entire ESG front, including on the energy front. And with regard to existing, like many of the company who are very strong, long on the thermal, the incremental project, the new projects they are bringing in renewable. And with all this thermal also, our conversation are in terms of how do I bring energy efficiency measures. So all the fossil fuel or thermal, borrowers as far as the bank is concerned, our lot of energy efficiency measures they are introducing, and the bank is very happy to fund them. Rather, we are slowly encouraging all these borrowers to look towards energy efficiency measures. There are multiple measures available now in terms of doing that. Some of the newer technology in terms of capturing carbon and recycling that is something a great concept going on. So as far as Bank of Baroda is concerned, clearly aligned with the government objective to make a net zero by 2070. At the same time, we are also capable of funding, although banking sector totally cannot fund the sector, the need for, let's say, 2 decades from now. There has to be other form of capital coming into the sector. But as far as the requirement is concerned from the banking side, we are quite aligned and we are capable of funding those requirements going forward also.
So I want to ask a follow-up question. You didn't speak about green securities. I mean, while there's a lot of green funding, but actually that funding is almost the same cost as normal funding. So, at one point of time we say we need money, but actually there is no difference. Do you think we need some intervention on the security side to be able to break the logjam?
It has to be actually. When the market evolves, we have seen that means all in the ecosystem need to have their role in terms of making it a much more viable proposition. So if everybody is aligned to a greener planet or the ESG mandate, we need to incentivize. That's like in India also we have seen this incentive reward structure does work well initially when you want to make a bigger impact there in the market. So I think going forward, these are all evolving. Like as a bank also we are quite keen to raise green bond, issue green deposit, but then there are certification process involved therein. So going forward, when market moves in a strong way, I think the aspect of the security aspect, the incentivization aspect, be it regulatory or otherwise, would evolve within the system. But the beginning has to be made, and the beginning has started in India in terms of looking into all these aspects, and possibly going forward, that would be a reality. I think that's my view.
Mr. Rao, I'll turn to you. Mr. Rao, I will turn to you. Mr. Mehta made a very important point. To support Atmanirbhar Bharat, the models, banking models have to get innovated, right? We have to keep innovating, and keep pivoting our model, our operating model. I think other panelists also mentioned the same thing. Now, there are many starts. You could think from an HR perspective, you can think from a technology perspective, from a data perspective, from a risk perspective, from a channel perspective. I know personally, you have really helmed many of those journeys. What is the bare minimum to start with? What is the first point to start with to innovate and pivot your business models to the need of future?
See, as far as the business models, again, I will come back to the same point. For any business to thrive, it should be a viable one. To make it viable, it is not just the business model alone is going to help us. Whatever the things that we work out, the role of each stakeholder has to be evaluated from the perspective of the viability. Otherwise, just to make it a Atmanirbhar, and then it should not end as a cost center. So to make it viable, what are the technology landscape that is there? What is the evolving regulatory environment? And then what the competitors are doing? These are all the things which are to be taken in a holistic way. As an island, I cannot say that this is going to be the business model which is going to excel in coming days. This is the overall picture we have to take.
Lovely, sir. Thank you so much. No, very clear. Mr. Mehta, I'll ask you an industry level question. If you really see India, in the past we have seen a bit of consolidation of our banking industry. Now, if you will have this high growth rates that is required from a banking side, and you also start to look at, some of the other countries. For example, US would have 9,000 lending institutions, if you take credit unions, if you also take the regional banks there, and so on and so forth. We also heard Deputy Governor just speak about innovation, focusing on specific target segments and stuff. I just wonder from your vantage position, you see India will have a lot more banks, India will be okay to do with large banks, fewer larger banks. What should be our aspiration as an industry? How many banks we should have in the top 100 banks of the world? We have probably one or two only right now. So just any perspective from an industry landscape, going in 20 years, will we have this room full of more bankers, or we will have fewer, sharper bankers?
So banking system is just like blood vessels in the body. The moment the body grows, the blood vessels have to grow to support the body. So banking system need to grow. If you want to increase the economy by 2 times, I think the banking system need to grow by 2 times. So that is the minimum requirement that I feel as an industry body. As regards consolidation, and yes, every country which is developed and they have some large size institutions, which comes into first 100 banks of the world, and then India is consolidation has paved the way for that some of our banks are already there and rest are on the verge of entering into that league. So that is a good step. Consolidation has provided that opportunity to become a big size bank to support the economy, and which can become systematically important. But country needs all type of players. You need niche banks, activity-based banks, you need mortgage banks, you need retail banks, you need a small finance bank, you need payment bank, because all these type of it provide a particular segment. One size fit all is not applicable in banking industry. Everybody has got a different specialization. Some may be very good at digitization. You may need a virtual bank also to support the next gen. Then you may need a physical bank, as rightly said by Rajeshwar and Rajji, that lot of, if you yourself said 60% population still lives in villages. It will take decades to migrate to lower percentages. Then how do you support them? The same model cannot support everywhere. So you will have to design different models, and fortunately we have such models. There is need for refinement and improvement in those models to suit out the growing aspirations of the customers in these segments. So banking system need to expand with the economy, and the differentiated models need to exist.
Wow, so more banks, more different type of banks. This audience has been fantastic, and I really appreciate that all of you are here at the very last session for the day, and this panel has been just fantastic. Let's see if there are any questions on your mind, before we kind of dive into the last section of this panel to conclude FIBAC 2023. Anything on your mind that you would ask the panelists? Yes, sir. Can we have the mics, please? Bol dijiye, sir. Maybe we'll hear it.
Like either it's a regular working capital or term loan, but still we find even with the public sector bank, structured products or hybrid products, those are not much in the way. So what is happening, like if I want a particular product, I may have to go to 2-3 different bankers. Ultimately it's done, but with a lot of efforts. If you want to plain term loan, if you want, any bank would give you plain working capital. If I ask for hybrid product or structured product, it becomes a little difficult issues. Like I will give you an example. There is one product with
let me just, I got it. So I think the question is, I think while bankers are innovating, and at the end of the day, the solution is there, but it takes a little bit of an effort. So from my perspective, I would say, obviously this is a very tricky kind of, everyone is kind of coming up the curve. But let's hear some bankers on how much do you think we are starting to move on innovation index? Is there something that you would like, any of the bankers would like to comment on, sir?
See, one thing has been very clearly realized by the banks that if you look at the market, the change that is happening in the market is moving away from the asset-based financing to the cash flow-based financing. And to offer a cash flow-based financing, the banks need to have the cash flow of that entity for offering a cash flow based financing. So the moment, let's say a CMS product where we capture the cash flow, so more and more banks getting into all this cash flow capturing kind of a thing, their ability to offer a hybrid and structured product will be much more. Already the churn has started a couple of years back, and bank like us pushing very aggressively with regard to capturing the cash flow and then possibly in a position to offer a structured or a hybrid product, and that's a change already started. The market moving away from cash flow, asset-based financing to cash flow-based financing, and possibly the kind of ask that the market has, possibly it would be a reality going forward.
So, sir, keep all your relationship with one bank. You're likely to get your needs met better. आप कुछ बोलेंगे, sir?
The behavior of the consumer has changed totally. The bank is also very sensitized also. This is the reason they are changing their product. So I will give an example of the PAPL. Whatever the chance I has told, totally it is based on the cash flow. Within 60 seconds, less than 1 minute, the person is getting the money sitting in their home without visiting the. It is also part of the innovation also, even the other thing also. So bank is very sensitive, even for the big advance, the corporate mein InvIT finance, what is the InvIT? Completely changed product. So bank is very sensitized also.
So, sir, the more data bank will, or more bank will understand you, I think. Sir, a question there? Yes.
Yeah, good evening. So, Ashish, I'm also Ashish. It's a very good panel, very good questions also. So, my listening governor sir, also deputy governor sir, he said collaboration is one of the key aspects of the future actually. So, the co-lending is one of the area which has been announced as a new baby in the system actually, but it is not taking up the way which it should take up basically. So, all senior bankers are here. How do you think the future of bank with the co-lending actually? Because this is one area where the MSME retail lending can grow. And what are the challenges which are there actually? Why it is not growing actually? So if we can understand.
Maybe I can understand. You have dealt with, I mean, you have interacting with the banks from a co-lending perspective?
Yeah, I'm interacting with all the banks. I have all the information.
So what are the 1 or 2 problems you have faced or where you have come?
So from my point of view, I'm also organizing one webinar tomorrow with all the banks. Panel people are there actually.
Okay.
The senior bankers are there. So I've done a lot on this. Basically.
So can you just say 1 or 2 issues?
2, 3 things are there. One is technology, one of the largest thought process, but technology should not be the hurdle because we are doing business otherwise also.
Okay.
Without technology in many areas actually. Then the implementation actually. So what is happening, what thought process, I mean, sir is sitting here actually. I've seen his bank co-lending model also, but they did the leader in the market actually. So the thought should come from the leader actually. This basically carve out the team actually because it should be a profit center. It's a business unit actually. I think many of the banks have not thought of a business unit actually. They are part of the different departments actually. So it can be one of the suggestions from my side. But
so Rajeshwar, you have been clearly pointed out. Why don't we give it to you?
As far as the co-lending is concerned, let me tell you, this is the model which is going to stay for a long time. Because whatever the plus that is there in the NBFCs and also whatever the complements that can be had from the commercial bank, that can be matched very well in co-lending. But as far as the right at this moment, whatever the factors that are contributing for the slow takeoff, number one is what we understood, because we are number one in the entire portfolio in the co-lending as far as the public sector bank is concerned. If you want to tweak your rule engine in your technology side, as per the way NBFCs tweaks their rules, their gap exists. But many of the banks are dependent, as far as the technology is vendor dependent. First of all, we have to understand, and then we have to make them to understand to tweak the software. That time lag. By the time these people develop that product, again NBFC changes its model because it's a very rapidly changing ecosystem. So it is only the catching up that is happening. That is the main issue that is there in the co-lending.
So it's a deep relationship. So, one has to also spend a lot of, the length of, relationship also matters. Before we get to another audience question, Mr. Rai, I have a question for you because you represent a very unique institution. You are like a startup in a government environment. And one of the reasons why you were given the kind of freedom was to attract talent. And I think you've been super successful in attracting very different kind of talent. So both from your vantage as a CEO of a very large bank and now as a startup, how do you think bankers should feel about talent? Which are the sectors, non-banking sectors we can get talent from? How does one nurture talent? Can you just give us a very brief point of view on this?
Yeah, it is difficult to be very brief on these issues but I'll try to be brief. The basic underlying principle, you can't continue to do the same thing and expect different results.
Right, sir.
We all continue to do the same thing and expect different results. Now, setting up NAPFID is expecting a different set of results, for which you need a different skill set. So, a lot of enablement. This is the first time an institution like this has been created with the government support, and if you look at the act itself, it's such a beautiful act drafted which is with so much of enablement, because you want a different set of results. Now, trying to draw that to public sector space, and that's what the question is, basically what is the learning and what can happen here. See, public sector is also given that liberty. Today, you can take your technology side people, you can take your risk side people, you can take your credit side people. Nobody stops you from giving market related salary, because we are also taking people on contract, they can also take. Thing is, for me as a startup, I already built a culture which is compatible for all these kind of players to come and work.
Culture.
See, now we are only 45 people who are working today, which is delivering this, and all the 45 are on deputation from 12 financial institutions and banks. So it's a good mix-up, but we are able to create that culture and we all work together. In public sector space, what happens, when you bring these specialists, they find it very difficult to cope up with the culture there and that ecosystem. System wants to push them back. Basically, that's how the public sector has been, because it's a huge setup basically. Over a period of time, decades together, we have worked. So it is the role of the CEO actually to bring that culture. CEO has to take a personal care when because many banks have made these interventions of getting a good technology officer, good risk officer. You need to create that enabling environment, and only CEO can do it, nobody else can do it. Give that freedom to him, give him the team to work, and also give a message that he is very important. Because see, what you are trying to do is to bring a different skill set.
Got it, sir. I think that's
if you are expecting a different result, you need different skill set. And different skill set don't come cheap. You can't expect that it will come from the same public sector space. It has to come from different sectors and they have to be paid accordingly. So that liberty has to be kept, and it is kept. But then we have to think very clearly before getting into this journey.
Wow, what accountability you have taken. I mean, all of you are CEOs and you have taken this accountability. I'm super impressed. Any other question? We will just have space for maybe one or two more.
So another area is just startup. Yes, you were talking about this is a startup. NAPFID is a startup, but there are more than 1 lakh startups are in the country. I am the chairman of one of the startup committee of EID Chamber of Commerce.
Okay.
So we are a lot actually, and then we are interacting with the bank. Still, if I see RBI has come out with a scheme, this guarantee scheme for the startup. Still, the momentum is not there actually. Again, because senior bankers are here, so it will help to all the startups
okay,
also.
Let me frame Goel sir, I will frame the question to you, because I think you are leading a silent revolution at PNB on digital and fintechs. What is your approach? How have you been able to get so many fintechs, and why some of these players feel they still can't approach you?
Actually, Ashish, we have to understand why we are doing, what is really need of doing such type of the work. Actually, I fully agree with you. We were too much of the behind as far as digital transformation, IT transformation is concerned. And I will tell you one statement of one of the very senior officer from the Niti Aayog. What they have told, if bank will not adopt the technology or the digital transformation, banking industry will remain there, but bank will not. So considering that statement, so whatever best we can do, we are doing. And lot of, because last 1.5 years, more than 65 either product and the services we have provided. And now I can say with proud that we are at par with the industry as far as digital transformation is concerned. Even we are also working for the HR transformation also. And you see the power of the benefit. It should be a business driven, not only you are doing for the compliance purpose, etc. Like I will give the example of what was the outstanding of this PAPL. It was only 50 crore rupees in June 2022. Today the outstanding is more than 4,000 crore rupees. Then you see the power and the convenience also. Today you see this mobile app.
Sir, I think if he can, I think this is good. No, no. The question is, if he
Yeah,
wants to come to PNB,
So,
will he be
sir,
welcome?
I mean,
Sir, as you
because
told-
lot of, just a minute,
Yeah,
lot
sorry.
of, because it is earlier what we were thinking ki there will be a competition from the fintech company, but today everybody is taking as a partner, as a collaboration. We have on board so many fintech company, we can create that out of our own also, but it is a time consuming and cost is also involved. So we are getting benefit of both the side, because if we will not take the fast decision, technology is changing so fast. If we will delay in the create out of our own,
Yeah.
I can say you even IBA as a, because I am the part of the IBA and Mehta Sahib is we have made each and every bank, we have given this task also, and we have called all the person who is involved in the startup, and lot of the, we have also funding this Bank of Baroda, every bank, suppose Karnataka, Bangalore, we have given the task to the Canara Bank in Delhi, task was given to us also, and we have brought all the startup also. But it will take time. It is on the initial stage also.
I think this is a big
Yeah.
statement being made by the chairman of IBA as well as MDC of PNB to say we cannot live without fintechs, and there is a collaboration thought process. Now, of course, processes take time. You may want it a bit faster. You know, we live in an environment, but I think the direction is clearly there and we see it. A question for you, Mr. Chand. You know, there is a lot of talk about AI ML. You were one of the first banks to introduce your entire data infrastructure. Often bankers say investment has been done, but no returns come out of it. But we also know there is no future without that. How has been your journey so far? Are you continuing to invest even more aggressively? Is it starting to make a dent? If you can just speak a little bit around the AI ML journey of Bank of Baroda.
That's fair. If you say that the data is the new oil or the wealth, banks are the storehouse of data. And to leverage the data, you need to have a tool like AI to leverage the data fully into business. As far as Bank of Baroda is concerned, we have been an early starter in terms of implementing AI across different business line. Currently, we have multiple use cases in terms of having AI, whether it is optimization of cash in branches, optimizing the cash in ATMs, whether it is a cross-sell, up-sell, whether you want to rationalize the branches, whether you want to predict the customer default probability, whether you want to study the behavioral pattern of the deposit. So we do have multiple use cases as on today with regard to AI. Rather, the bank is going for a generative AI at this point of time and implementing a proof of concept now. So as far as Bank of Baroda is concerned, we strongly believe that in case we need to leverage the wealth that we do have, AI is the tool. AI is nothing great as compared to earlier we used to have a simple modeling in Excel, but now AI is more in terms of understanding the customer profiling and then trying to best optimize the case. The future for AI, in case I look into how do I again look into AI going forward, as far as investment is concerned, there is a due return. The return not in terms of numerical numbers, but in terms of tangible value that we derive out of using AI for business. There are two things that we need to again look into going forward on the AI with regard to the recent bill of DPDP, the data privacy bill, and something like we normally hear the deep fakes and all. So keeping these two into mind, we are again realigning our entire AI framework so as to align the usage of AI for the new bill, that is the DPDP one. At the same time also, sometime the AI should not be, bringing in any kind of a disruptive impact in business because of the deep fakes that we talk about. So great, at this point of time, the usage has been very significant as far as Bank of Baroda is concerned. In terms of the outlook for my investment into AI, it would continue to be more stronger and more larger. But at the same time, I'm also conscious of the fact that we need to align the usage of data in terms of the new act, which can be the primary principle of that act is in terms of the customer consent. So we are aligning AI based on that and trying to figure out the best use case for us.
So next time we are talking to a Bank of Baroda call center agent, maybe we are talking to a bot and not really a human being.
True.
I'll come to a rapid fire and close this session. I'll pick up, I'll get inspired by Mr. Rao's point. There are 5 things in Atma, and It's not just us, but everyone needs to move forward. So as banker, if you have one ask of an other stakeholder of what they should do to support banks, or they should do something on their side which can make your journey easy, what will be that stakeholder and what will be your ask? So maybe I'll start with you, Mr. Rao, given that you started the point.
See, to cut it short, let me be very specific. If infrastructure has to be built to drive the economy, in the infrastructure space, as far as the lenders are concerned, we have to do away with the performance and financial guarantees. And the stakeholders like government departments or state departments or utilities should be made as a consortium members to drive the project to be completed in time to avoid the cost overrun.
Very bold. Mehta sahab.
I think Mr. Rao has very rightly said, the business model that we are pursuing today need to be changed. And that will happen from the banking industry, converting ease of doing banking. And the government will have to complement it by providing the legal support and the enabling environment to undertake that business model reformation.
Lovely. So a lot of support from the government to pivot into these models. Raisa?
Yeah. I may have two asks, not
Sure,
one.
sir.
Actually, first will be developing the secondary bond market and secondary loan market, because particularly from the project finance side, because if the country is growing at this phase, this is the space where a lot of investment will happen, a lot of loans will happen. So developing secondary loan market, we have already created a company, but it is not activated to that extent. This is very important because for the asset liability management of the banks, so developing this is very important. Secondary bond market to provide liquidity to the corporate bonds, because these are not well developed. These are the two asks. All of us have to contribute to this, but this has to happen. Another very important thing is, as we talk of long-term funding, a scheme like S4A has to come back. This will be asked from the regulator, because the project financing life cycle is so long. It is impossible to make a 30-year assumption on what will be the cash flows. Things are going to change. So, resetting of the loans on two things, like elongation of the repayments and reducing the interest rates, and also right sizing of the debt has to come in. We should accept actually, particularly in these kind of long-term loans, sometimes it may so happen that you may have to downsize the debt. You may have to write off portion of the debt and assume that maybe 60%, 70% of the debt is sustainable debt, and we are okay with that, not treating it as NPA and kind of thing. So these are things actually, this mindset change need to come in, and if that change comes, the country is prepared for the next phase of growth.
Ashish, in my opinion, as a banker, now there is no credit risk. It has been completely wiped out. Now how we are in a position to manage the interest rates. Whatever Rao Sahab has told, I fully agree with him, because there is a ALM mismatch. How we can address, because if you see what is the deposit on the liability side, whatever we are giving on the asset side, so secondary bond, loan secondary matter, and IBA is working on that. IBA is working on that. A lot of meeting has already been. This will be the game changer. Otherwise, we will not be in a position. And I have also told in my deliberations regarding the MSME, that is the responsibility of the every stakeholder. Then we will see what is the role of the banker. If we want to, as Rao Sahab has told, infrastructure has to be created. There is a role of the banker also. We should come forward to finance such type of the infrastructure project.
See, I believe always market is not created to be created. So a lot of emerging needs like green financing, non-SLR market, carbon market we are talking about, these are to be created. For that, the only ask could be that some of the relevant players who are dominant and relevant need to take their first step so as to create the market going forward.
Wow, it seems like bankers are ready to take 5 steps, not 2 steps, if others take 1 step. Irrespective, they will take the steps to really support the Atmanirbhar Bharat dream. It was just delightful to be moderator of this wonderful panel. I think we got a lot of ideas. My heartful thanks to all of you.
Thank you all dignitaries. I now request Shri Sunil Mehta, Chief Executive IBA, to deliver the concluding remarks and vote of thanks.
Media to request, wait for some time till we conclude. Media personnel are requested to wait for some time till we conclude. Expect the cooperation from media people to wait till we conclude. In a city like Bombay, where everybody has to travel for a long distance, I can understand the anxiety of the participants to leave early for their home, so I'll keep it very brief. I think most of the deliberations were attended by the participants and they are fully aware about the key takeaways. So I'll cut short the concluding remarks on the deliberations of the individual panel. But as a host, this is my duty to convey my sincere thanks to our Chief Guest, First Honorable Governor, Reserve Bank of India, who provided a great opportunity to all of us in understanding the regulator's perspective during his deliberations with us. I'm equally thankful to our concluding Chief Guest, Deputy Governor, Reserve Bank of India, Shri Rajeshwar, for providing his valuable time and giving us his perspective about the forthcoming regulatory landscape for the banking sector. My sincere thanks to all the MDs and CEOs of the public sector bank, private sector banks who participated into the various panels, EDs and the senior executives of various banks who deliberated into the party panel, and the participants from the various banks and financial institutions, fintechs, and other important stakeholders in this conference. My thanks are due. Without you, this conference would not have been successful. My thanks to the media for covering this event elaborately today about the yesterday, and I expect the same for tomorrow. My sincere thanks to the entire FICCI team for supporting us jointly in organizing this program. Last but not the least, thanks to my own IBA team for burning their midnight oil to make this event as a successful. I think the success could be seen in the yesterday's participation, in the today's day-long participation. Thanks to the Hotel Trident team and our support teams from audiovisual systems and the event partners for creating the excellent arrangement. I hope we'll continue to get this similar type of patronage and support in our future events also. Thanks for your participation today. Wish you all the best.
Thank you, sir. With this, ladies and gentlemen, we come to the end of the most enriching IBA FICCI Annual Banking Conference. Thank you all. Have a wonderful evening and stay safe.